This morning, an internal diplomatic cable from Global Affairs Canada landed on my desk, confirming a highly unusual realignment of state resources. Yesterday, a senior delegation of Canadian trade officials arrived unannounced in Tokyo, carrying a comprehensive list of energy and agricultural asset inventories destined for the Indo-Pacific. That specific sequence of events tells you that the quiet architecture of a new global supply network is being assembled in real time. That sudden strategic shift is a direct departure from a decades-long trajectory that defined North American commerce. When NAFTA was signed back in 1994, Canadian exports to the United States were already dominant but manageable. Over the next 30 years, that commercial relationship deepened into a structural trap, leaving Canada exporting roughly $600 billion worth of goods annually to a single customer by 2024. When that customer changed the rules overnight in early 2025 by imposing sweeping 25% tariffs on Canadian steel, aluminum, and auto parts, the vulnerability of that exposure became undeniable. The immediate consequence of that policy shift was measured in immediate financial disruption. Within the first quarter of 2025 alone, Canadian exporters faced an estimated $8 billion reduction in projected revenues, forcing automotive assembly plants in Ontario to recalculate production costs within 48 hours. That disruption triggered a fundamental reassessment within the highest levels of policy planning in Ottawa. The core question confronting the state was no longer about negotiating terms, but about structural survival. The policy response that followed demonstrates a calculated choice to systematically build financial exits away from the North American corridor. That shift began directly with the accelerated activation of the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or CPTPP. While Canada had been a member since 2018, its trade volumes within the bloc had remained static. But the 2025 tariff shock caused Ottawa to aggressively scale up resource allocation to the Pacific. Japan, representing a $4.2 trillion economy, became an immediate priority for Canadian agricultural and energy infrastructure pipelines. According to recent projections from Global Affairs Canada, this deliberate Pacific pivot is engineered to unlock an estimated $250 billion in additional trade capacity over the next decade. That framework structurally alters the destination of Canadian commodity wealth, ensuring that a rising percentage of grain, canola, and liquid energy bypasses American ports entirely, simultaneously. A parallel restructuring was initiated across the Atlantic, targeting the $3.1 trillion economy of the United Kingdom. The existing Trade Continuity Agreement, a temporary framework established post-Brexit, was quietly abandoned in 2025 in favor of negotiations for a permanent, comprehensive bilateral free trade agreement. That process was heavily backed by Canada's largest institutional investors, including the Canada Pension Plan Investment Board, which manages over $570 billion in assets and began shifting capital directly into British infrastructure networks. Data generated by trade economists at the University of Toronto indicates that a finalized Canada-UK agreement will generate between $25 billion and $40 billion annually in new bilateral trade within 5 years. What that framework does structurally is redirect the gravity of Canadian financial services and clean technology exports toward European capital markets. At the same time, the Canada-European Union Comprehensive Economic and Trade Agreement, known as CETA, underwent an unprecedented commercial reboot. European industrial manufacturers, particularly in Germany and France, were actively looking to diversify their own supply chains away from unpredictable American suppliers. German industrial conglomerates opened direct procurement channels with Canadian aluminum producers, including Rio Tinto's massive Arvida operations in Quebec, seeking long-term supply guarantees. The European Commission's Trade Economics Unit estimates that a fully optimized CETA framework holds the potential to move $100 billion in bilateral trade over the next 10 years. That massive volume sitting next to the $8 billion quarterly loss from American tariffs provided an absolute baseline for Canada's medium-term economic planning. This multi-front expansion was further accelerated by the rapid mobilization of Canadian institutional capital. The Caisse de dépôt, managing over $400 billion in Quebec pension assets, announced a targeted $15 billion Indo-Pacific investment strategy in mid-2025 to build the physical plumbing that trade agreements require to function. That deployment of capital into foreign ports, logistics networks, and energy terminals ensures that Canadian exporters possess the dedicated infrastructure needed to move high volumes of cargo independently. Preliminary trade data from late 2025 already reveals the initial baseline results of this coordinated strategy, with Canadian exports to CPTPP partners rising by 12% year-over-year. But the more consequential question, the one that central bankers and maritime logistics firms are watching with intense strategic scrutiny, was whether this rapid construction of new financial corridors could outpace the immediate, compounding erosion caused by the trade restrictions closer to home. That strategic tension hinges on a clear operational vulnerability. While new legislative frameworks can be ratified quickly, the physical flows of merchant shipping and commodities alter their path at a much more deliberate pace. The 12% baseline increase in Pacific trade achieved in late 2025 demonstrates that the initial redirection of capital is functional. But that progress remains dangerously exposed to the compounding impact of American tariff restrictions closer to home. To counteract that friction, the Canadian state transitioned from defensive market management to an aggressive, well-funded reallocation of sovereign resources designed to permanently break the 76% dependency model. The foundation of this deployment was formalized through a major policy decree issued by Global Affairs Canada, which officially codified a 10-year mandate to double the value of Canadian exports to non-American markets by 2035. That initiative commits $7.2 billion in departmental spending and reconfigures the operational parameters of the Canadian Trade Commissioner Service to support a projected $300 billion expansion in alternative trade. That specific fiscal allocation tells you that Ottawa is no longer treating diversification as a temporary diplomatic countermeasure, but as a core national security directive. What that policy framework does structurally is insulate Canadian small and medium-sized enterprises from future regulatory shifts in Washington by subsidizing the fixed costs of entry into high-growth maritime corridors. Build Canada, that domestic pivot was immediately matched by coordinated legislative actions designed to deepen access into premium European procurement channels. During the March 25 bilateral summit in Toronto, trade officials from Canada and the European Union formally launched negotiations for an expansive digital trade agreement to complement the existing CETA architecture. That legislative addendum removes regulatory barriers on data flows, electronic commerce, and cross-border digital services, which collectively represent the fastest-growing segments of high-margin corporate trade. By removing that digital friction, Canadian technology firms gain a standardized legal baseline to compete directly for public and private contracts within an $18 trillion market. EU trade, European Union. To bridge the immediate cash flow deficits plaguing domestic industries during this structural transition, the federal government weaponized the balance sheet of Export Development Canada. The state agency was authorized to expand its active trade facilitation portfolio by $25 billion by 2030, targeting high-value sectors such as critical minerals, defense procurement, and clean technology. That capital injection acts as an explicit financial shock absorber, offering low-interest credit lines and sovereign insurance to firms whose American margins were erased by the 25% tariffs. What that intervention reveals is a deliberate strategy to prevent a wave of domestic bankruptcies from occurring before the new international infrastructure pipelines reach full commercial maturity. CD. How institute the strategic imperative driving this rapid realignment was made entirely transparent by the actions of the state's executive leadership. While attending the World Economic Forum, Prime Minister Mark Carney defended the accelerated diversification agenda, stating directly that a sovereign nation cannot permit its economic security to be dictated by the unilateral actions of a single trading partner. What that response reveals is a calculated choice to frame the trade friction not as a temporary bylaw, tariff dispute, but as an existential threat to Canadian economic sovereignty. This public pronouncement signals to global asset managers that Canada is permanently reorienting its regulatory alignment away from North American exceptionalism and toward broader multilateral alliances. That public rhetoric is supported by deep structural shifts within Canada's primary resource exporting sectors, particularly in the energy landscape of Western Canada. The phased activation of the LNG Canada terminal in British Columbia allowed energy companies to bypass Midwestern pipeline networks entirely, initiating long-term supply deliveries directly to utilities in Tokyo and Seoul. That maritime alternative alters the pricing dynamics of Canadian heavy commodities, allowing domestic extractors to capture global index prices rather than accepting the steep discounts historically dictated by American refining conglomerates. The long-term implication of this logistical independence is a permanent reduction in the volume of energy assets flowing south, directly undermining the supply stability of the American industrial Midwest. However, the real indicators of structural transformation are emerging from the domestic manufacturing sector, where the friction of the tariff war has triggered an acute reallocation of industrial capacity. Data compiled by Canadian manufacturers and exporters reveals that 49% of domestic manufacturing firms are now actively developing non-American export operations, while 16% have migrated specific production assets out of the country entirely. That divergence in corporate behavior shows that while raw material sectors can adapt via maritime transit, complex manufacturing supply chains are facing localized contraction. The outcome of this structural bifurcation will be determined by an impending milestone, the mandatory joint review of the Canada-United States-Mexico Agreement, scheduled for 2026. A high-stakes diplomatic confrontation that will dictate whether the integrated North American automotive ecosystem can survive, or if it will fracture irreparably. Navigating this intricate matrix of high-stakes litigation, shifting industrial capacity, and multi-layered sovereign finance reveals a structural reality that cannot be managed with conventional diplomacy. The multi-front pivot executed by the Canadian state across the Pacific and Atlantic basins is no longer an experimental hedge, but an operational necessity forced by a permanent rupture in continental relations. This strategic decoupling forces a comprehensive reassessment of how medium-sized, resource-rich powers must operate within an era defined by aggressive regional protectionism. By tracking the reallocation of institutional capital and the physical reconfiguration of supply networks, the long-term strategic trajectory for all major global actors becomes entirely clear. For Canada, this accelerated diversification signals a costly but inevitable transition toward genuine economic maturity. The state is systematically dismantling the comfortable, low-friction dependency that defined its continental commerce for half a century, trading a single dominant relationship for a highly complex, diversified portfolio of international commitments. This structural reorientation means that while domestic profit margins will face near-term compression due to increased shipping distances and regulatory adaptation, the long-term risk profile of the state is being profoundly minimized. The survival of Canada's sovereign credit rating and sovereign wealth management now depends entirely on whether its state-backed infrastructure investments successfully bridge the gap before domestic industrial centers suffer permanent contractio. On for the United States. This quiet exodus of its primary northern trading partner represents a slow-burning but highly consequential erosion of its industrial security. By weaponizing tariffs to achieve immediate political leverage, Washington has inadvertently incentivized its most stable supplier of critical minerals, energy resources, and advanced manufacturing components to build permanent logistics corridors to external buyers. That structural shift means that American manufacturing hubs in the Midwest will increasingly find themselves competing with European and Asian procurement agencies for essential inputs that once flowed south automatically by default. This loss of preferential access weakens the long-term resilience of the integrated North American supply chain, rendering the domestic American economy far more vulnerable to global price shocks. Concurrently, this systemic realigning creates an unprecedented strategic opening for Europe and high-growth Pacific economies. By integrating their supply frameworks with Canadian resource security via upgraded CETA and CPTPP architectures, these trading blocs are securing a highly reliable, legally stable alternative to Chinese commodity dominance. That access allows European industrial giants and Asian technologies networks to stabilize their long-term manufacturing inputs without relying on unpredictable trans-Pacific shipping lanes or vulnerable maritime choke points. The strategic consequence of this cooperation is the formation of a brand new, highly resilient multilateral axis that explicitly operates outside the regulatory orbit of Washington's trade policy. Ultimately, the overarching pattern revealed by this historic pivot demonstrates that economic integration is never permanent when decoupled from shared strategic stability. The single most important takeaway from Canada's rapid trade reorientation is that economic sovereignty cannot be maintained on a foundation of unilateral vulnerability, no matter how lucrative the historic relationship appeared on paper. When the operational rules of continental trade were rewritten overnight, Ottawa was forced to realize that a nation relying on one customer for 3/4 of its income is not a trading partner, but an economic hostage. The ongoing fracturing of the North American corridor proves that when state security and economic dependency collide, the architecture of global commerce will always adjust to survive.